Understanding working capital and its role. Working capital is the lifeblood of any business. It represents the resources a company has available to manage its day-to-day operations. In simpler terms, it's the difference between a company's current assets and current liabilities. Current assets are those that can be converted into cash quickly, like accounts receivable and inventory. Current liabilities are obligations due within a year, such as accounts payable. Effective working capital management is crucial for several reasons. First, it ensures a business can meet its short-term financial obligations. Imagine a scenario where a company cannot pay its suppliers or employees due to a lack of cash flow. This can severely damage the company's reputation and even lead to insolvency. Second, efficient working capital management can boost profitability. By minimizing the funds tied up in inventory or speeding up the collection of receivables, businesses free up cash that can be reinvested for growth or distributed to shareholders. Finally, robust working capital management provides a cushion for unexpected events. In today's volatile economic climate, businesses must be prepared for economic downturns or sudden shifts in demand. A healthy working capital position allows companies to weather these storms and emerge stronger. In conclusion, mastering working capital is not merely a financial exercise, it is fundamental to a business's survival and long-term success. Asset growth and the need for external financing. As businesses expand, their need for working capital increases. This growth in working capital stems from the growth in current assets, which often outpaces the growth in current liabilities. To understand this, we need to delve into the nature of asset growth. When a company experiences rising sales, it naturally needs to increase its production to meet this demand. This increase in production necessitates higher inventory levels, raw materials, work in progress, and finished goods. Simultaneously, as sales increase, so do accounts receivable, reflecting the credit extended to customers. However, the timing of cash inflows and outflows is rarely perfectly synchronized. A company might need to pay its suppliers for raw materials long before it collects payments from customers. This mismatch between cash inflows and outflows creates a funding gap, and this is where external financing comes into play. External financing bridges the gap between the company's working capital needs and its internally generated funds. This financing can come in various forms, each with its own costs and implications, which we will discuss later. The key takeaway here is that as businesses grow, they need to secure external financing to support the increasing working capital requirements driven by expanding operations. Level production versus matching sales and production. When managing working capital, businesses face a crucial decision: how to align their production with fluctuating sales patterns. Two primary approaches are level production and matching sales and production. Level production involves maintaining a steady production rate throughout the year, regardless of monthly sales fluctuations. This approach offers several advantages. First, it allows for better production planning and utilization of resources. Factories can operate at a consistent capacity, reducing the need for costly overtime or layoffs. Second, level production can lead to economies of scale. By producing in larger batches, companies can negotiate better prices for raw materials and reduce per-unit production costs. However, level production also presents challenges. When sales are slow, inventory levels can balloon, leading to higher storage costs, potential obsolescence, and increased risk. On the other hand, during peak seasons, the company might face stockouts if the pre-produced inventory cannot meet the surge in demand. In contrast, matching sales and production involves adjusting production levels to directly mirror sales patterns. This approach minimizes inventory holding costs and reduces the risk of obsolescence and stockouts. However, it requires a flexible and responsive production system that can quickly adapt to changing demand. This flexibility often comes at a cost, including potential overtime expenses, increased machine wear and tear, and challenges in maintaining a stable workforce. The choice between level production and matching sales and production depends on various factors, including the nature of the product, demand predictability, per-unit production costs, and inventory holding and shortage costs. Liquidity, cash flow, and financing approaches. Liquidity refers to a company's ability to meet its short-term financial obligations as they become due. It reflects the ease with which a company can convert its assets into cash without significant loss in value. Maintaining adequate liquidity is critical. Without it, even profitable businesses can face financial distress. The cash flow cycle illustrates the flow of cash through a business. It represents the time it takes for a company to convert its investments in inventory back into cash from sales. This cycle involves several stages. Cash outflow. The company purchases raw materials and incurs production costs. Inventory raw materials are converted into finished goods. Accounts receivable. Goods are sold on credit, creating accounts receivable. Cash inflow. The company collects payments from customers, completing the cycle. The cash conversion cycle, or CCC, quantifies the time lag between cash outflow and inflow. It's calculated as CCC equals inventory days plus receivable days minus payable days. The CCC provides insights into a company's working capital efficiency. A shorter CCC indicates quicker cash generation, reducing reliance on external financing. Companies can adopt various financing approaches: hedged approach, matching the maturity of financing with the maturity of assets. Long-term financing funds permanent working capital and fixed assets, while short-term financing covers temporary needs. Conservative approach utilizes more long-term financing even for short-term needs. This reduces refinancing risk, but might result in higher costs. Risky approach uses short-term financing for a larger portion of working capital needs. While potentially cheaper, it exposes the company to higher refinancing and interest rate risks. The choice of financing approach depends on factors like risk tolerance, cost of capital, and cash flow predictability. Please subscribe, follow, and comment for more content.